All right. All right. We still got people joining us, but we'll go ahead and get started. So Carson and I, we're going to go through kind of our end of the year market update. It's been, as always, another exciting year, I guess you can call it that, in the markets and politics and the economy overall. We've got some good informative slides we're going to go through, and as always, we're going to do Q&A at the end. So just, at the bottom of your screen, you should be able to ask questions. And if we notice it during the slides, we may address it then. If not, we'll certainly get to all the questions at the end. So please do that. And then we will also send out a replay to all of our clients and all of our listeners after, a couple of days after. So, all right, with that, we'll get started. Hey, Carson.
Yeah, I think it may be more of an economic update. I feel like a lot of slides and content that we have in here are more about the economy, not necessarily about the stock market, but we've got a good share of stock market updates in here too. But David, give me your opinion when you look back to 2025 as a whole. If we were sitting here 1 year ago, I would say it probably didn't meet your perfect expectations of what the stock market and economy did this year. But how do you
Yeah.
reflect when you look back on 2025?
Yeah, I mean, I look back and, we came out of a contentious election. And as Trump came in, it was kind of could have gone in any direction with tariffs and everything. And then we had, the tariff tantrum in early spring and April. Market fell 20% quickly. So I was kind of like, here we go. And, I don't know, 6 weeks, month, two later, whatever, it recovered all of that. Felt very much like March of 2020 with COVID when the market fell like 33% in 30 days and then recovered in 6 weeks. So what I learned from that is just that the market continues to blow my mind with how quickly recessions and bear markets are lasting. It's just the market's very resilient. It's very quick. What used to feel like, earlier in my career over 20 years ago, if you had a 20% down year, it was usually like a 12, 18 month, 2 year type of, slow drag, kind of you had a drop and maybe a slow V kind of return, and now it's just happening so quick. So more so than ever, getting caught up in that craziness and trying to time the market. It's never worked before. It certainly doesn't work now, and investors get rewarded for staying the course. And I could have made it. You mentioned a year ago, I could have made a case either way that the market's going to explode because favorable tax policy and there's record amounts of cash on the sidelines, and interest rates are probably going to go way down. And I could have made the case that there's going to be so much contention, the tariffs and everything are going to wreak havoc. The market's going to have to absorb that. Technology companies are so overvalued. I could have seen a 25% drop or a 20% increase, and it happened to go in the positive way. So it's very humbling and reminds us that none of us are market savants, but we, at Adams Wealth Partners, we have to be really, really good at staying on top of this stuff, but building financial plans that stand the test of ups and downs in the market while making sure we have enough liquidity, enough cash, enough emergency reserves, and then making sure that we have the right allocation to fixed income. Because for the first time in a long time, we're actually getting paid again on bonds and fixed income. You can get 4, 5, 6% on pretty conservative investments, where for the last 5, 10 years, you're getting essentially 0 or 1%. So it was a little trickier. So there, I'll stop there. What about you? Would you
Answered the
agree with
question
that?
perfectly.
Perfect. Yes.
Took the words right out of my mouth. No, I think um, the lesson learned really and the reflection coming back to 2025 is, like you said, that emotions can sort of take over sometimes with how we all view the stock market and the economy based on what you're reading in headlines, and especially in April. We're reading all the same headlines. We see all the same news. We see the stock market going down, and it's never fun to participate in such a fast drop like that. But what I think we do such a good job, and why we're professionals at this, is not letting those emotions dictate our investment decisions. It comes back to, just like you said, fall back on the financial plan. What do we know about the stock market? Do we need this money right now, or do we have a 10 or 20 plus year time horizon? Or, like you said, do we have fixed income position in our portfolios that's up while the market's down 20%, that sort of thing. So it takes you back. Having shocks like what happened back in April, I feel like takes you back to your roots and brings you back to remembering why do we build financial plans, and what are our financial plans based on. They're not based on what the market does during a 1 month period.
And also, like in
Yep.
those drops, we also use that time to make, lemonade out of lemons. We look at, can we rebalance the portfolio? Can we generate some tax losses short term that can really benefit you on your tax return in April the following year? Tax loss harvesting, that's called. So we just have gotten like when we see that happen, like, all right, team, let's, sharpen the pencils. Nobody uses pencils anymore, but let's sharpen the pencils and let's go through, client portfolios and see how we rebalance, how we adjust risk, and then also if we can generate, a chunk of capital loss carry forwards that can benefit the client forever to offset gains, which we now have had. So,
Mhm.
but yeah, that's
All
how,
right. Well,
yeah.
all that being said, let's get into it.
Let's do it.
So first slide here, let's just do a market overview of where the stock market's at this year and the wild ride that we've had. So uh, the pink and orange here are international indices. So the pink specifically is the European stock market. The indice below that, that's up about 29% year to date. That's just the all country world index without the United States. So it's basically all the other global assets without the United States impacting it. And we're seeing for the first time in a very long time international consistently outperforming the United States this year. So this screams the importance of why diversification is there and why we have diversification and why we don't just completely abandon an asset class whenever it's not working. There's certain asset classes that come in and out of favor, but we're never going to be able to time. I don't think it was on our radar early this year that, oh yeah, international is absolutely going to outperform.
Yeah.
No, we weren't necessarily expecting that, but we still hold it because we know that's a great part of diversification and it works in years like this year.
Yeah. And I want to add to that. I had a lot of, for the last 10 years or so, we've been very underweight international, but we didn't abandon it to Carson's point. And, a lot of the research would say, why own international? US, is the prettiest house on an ugly block. And so maybe, in a portfolio, if somebody was 80% stocks, maybe 65% of that was US and only 10 or 15% was international. So we were lower allocation, but then that still helped this year when it finally popped. But do we believe though, just because of a year like this, and now, oh gosh, we need to go back to how we used to balance portfolios in the early 2000s, where it was half international, half US? No, I don't think so. I still think the US is kind of where you want to be over allocated, but we'll continue to keep a healthy allocation to international. But I would,
Mhm.
I would not expect this to be the case over the next 5 years. But who knows?
I agree. Let's look at, a lot of the headlines are all around the Magnificent Seven. So that Magnificent Seven being Apple, Amazon, Tesla, Meta slash Facebook, Google, Microsoft, and NVIDIA. And the tail of the tape in 23 and 24 was a large portion of performance in the overall stock market was made up by the Mag 7 stocks. Specifically, this chart is from 2024. So this is last year.
Okay.
NVIDIA was up 170% for the year. And then you look further below that, all the Mag 7 stocks except one, Microsoft, was up beyond the index. And when you have a cap weighted index like the S&P 500, 35 to 40% weighting coming from these names, that's going to have a massive impact on the index, even though the rest of the S&P 493 or the whole other part of the index may not be performing well. The index can still be up because these stocks are up so much. Then let's fast forward. Here's 2025, a pretty different story. So all but two names are underperforming the S&P 500. So you've got two names. You've got Google, especially here recently, and you've got NVIDIA that are still outperforming the index. But the rest of the Mag 7 are kind of in line or underperforming the market. And what this has told us and told me that not everything is working this year. This year has not been where just everything is going up. This list right here, there's no need to be able to read all the names and see all the specific details. But what picture this paints is there are some massive companies and some names that we're all familiar with that are having pretty bad years in the stock market. Companies like United Health, Target, PayPal, Procter and Gamble, General Mills, Adobe, Salesforce. So even some technology names that are having a really bad year this year. It's not this, and the reason I want to bring this up is there's a lot of talk of, is this an AI bubble? And is this just tons of massive valuations, everything going up right now? Well, everything's not going up right now. There's tons of companies that we all know about that are having really poor years. Now, there's companies that are having phenomenal years and having phenomenal stock price returns this year, but it's not bubblish from our perspective.
I mean, yeah, it is wild to sit there. You look at like Lululemon down 50% in the same year that, Warner Brothers up 150%. I mean, it's wild. That's
Totally.
absolutely have to say diversified.
And we know what drives stock market performance at the end of the day is earnings growth and earnings per share. This slide paints a perfect picture, and I think screams why the stock market's up 15% this year is because look at the latest posted quarter Q3 earnings. We are up 22%. S&P 500 companies are up 22% year over year. That's just earnings growth. That's not multiple expansion. That is just pure dollar for dollar. Earnings are growing 22% year over year. So when we say it doesn't make sense that the stock market is up 15, 16, 17% this year. Yes, it absolutely makes sense because companies are truly growing their bottom lines right now. It just now, if it was the opposite, we can talk the AI. I have a couple slides here that paints the picture again. This is NVIDIA. So we have what's called a PE ratio, price to earnings ratio. It's basically, is a stock expensive? Is it cheap? What's its valuation? In orange, you see NVIDIA's stock price. Obviously, it's surged massively over the past 3 or 4 years, and their PE ratio. As you can tell, the trend here, NVIDIA's stock price has continued to climb while its valuation has fallen. So it's getting cheaper, arguably. It's getting cheaper while NVIDIA's printing billions of dollars of cash every single
Which is
quarter.
showing, yeah, that there's lots of cash and earnings happening under there. Whereas you
It's
go back to,
justified. Its price.
yeah, you
Yes.
go back to the internet bubble, um, back in 99 and 2000, the challenge there is you had companies being valuated at 100, 200 times earnings, or they just had no earnings at all.
Or
So
no earnings.
it
That's
was
right. Yeah.
all hypothetical, like this
Mhm.
company's really going to pop and the price is $300 a share, but it's making $0. So when you hear that, do I think that you're going to have, a tech crash? No, because there's underlying growth. Is it possible stocks like this that have run up 200% can pull back 20, 30, 40% temporarily?
Totally.
Absolutely, but then it would be very short-lived because there'll be so many people that weren't in Nvidia that now like, oh, Nvidia stock just dropped 40%. I want to get in. Hedge funds, individual investors would rush into it and it'd probably go back up within 3 weeks. So it's kind of, I don't think these names are going to, AI bubble is going anywhere, gonna happen or implode. But I would
Mhm.
expect bigger highs and also some bigger drops in those, and that would just be expected when you invest in an asset class like technology and specifically AI.
Exactly. Technology, specifically AI, can have massive ups and downs. I love this example. Here's Amazon stock price from 1998 until through 2002. Amazon experienced a 95% drop from the top in late 99 to the bottom in late 2001. 95% of Amazon stock was deteriorated, just a 95% fall, which is unheard of. And at the time, it may have been, okay, is this company going to make it? They did. And we zoom out and look at the stock price now, split adjusted, $231 a share. That little blip on this chart over in the year 2000 is what we were just looking at. How just because, like David was saying, NVIDIA, a company that's printing billions of dollars of cash, it doesn't mean they can't be susceptible to a larger stock market drop where they pull back 40%. But it's not like the AI bubble where there's no earnings to back it up. A
And there,
company like NVIDIA, it's justified.
in case in point, look at the drop when it went from like 160, 170, fell in half again just a few years ago. Did that mean Amazon was going away and you needed to, run to the hills and get at it? Absolutely not. Now it's, gone up another 50% from its previous high. So that's kind of more just what we're saying. And I think most of our clients realize that, but it's easy to forget when you see something fall 50%. In fact, the phone call we ought to be getting and the advice we ought to be giving when that happens is if you liked Amazon last year and it's down 50%, you should buy more.
Exactly right. Exactly right. Let's talk about the U.S. because there's been lots of conversations this year with gold. Gold's up 60% this year. It's had, I think, one of the best years it's had on record. A pretty phenomenal market performance this year on the price of gold. And on top of that, the US dollar has had a very, very bad performing year. So you combine those two, and it's helped international assets, but we've also gotten questions about gold. Does gold hold a spot in a portfolio, and why is it going to continue? Um, all while we have a government that's has a deficit of almost $2 trillion and the debt ever increasing. I don't know, what's it at, 37 trillion,
Mhm.
38 trillion, something like that. And I think the questions asked, is the US losing its appeal globally? And is the US going to not become or stay the powerhouse globally in the kind of the global reserve currency? I don't think so. Hold on. I think it's going to continue. I don't think
Yeah.
it's going away. I have
I've been
the
hearing that
bullet
for
point
20, I've been
here.
hearing that from 20 years. And I think that, yeah, we continue to make the case stronger of why it shouldn't be. We continue to erode the, attractiveness of the US as a safe haven when things get really scary. But I don't think we're like, who's the backup? I still think
Exactly
I
right.
think we're making it worse and less compelling, but I don't think we're anywhere close to that happening. Um,
Exactly right. I mean,
that's
we
why
went
gold,
from
that's why gold went way up is because it started to look like, oh gosh, the dollar's deteriorating, things are tariffs, all this stuff's going on. Gold's always the place to run after the dollar, but it's always been temporary.
That's right. And I think what didn't help the US's case, now, right, wrong, or indifferent, they froze Russian treasury holdings in 2022 with the Ukraine war. You got to think that's not just penalizing Russia. Other countries are going to see that and see, hey, that's a massive implication. My reserves from the US, they can just freeze them in an instant, and I don't have access to those reserves. That kind of sent a ripple effect, and why the amount of gold purchases by foreign institutions has increased heavily, thus causing the price of gold to go up pretty substantially. So other countries see that and they want to place it in something where they won't have their assets frozen. Countries like China and Russia both, and other countries across the world have massively increased their global gold
Yeah.
reserves. But still, bottom line, U.S. share of global reserves has gone from 72% in 2021 to 58%. So it's fallen more recently at a higher pace. On average, over the past 20 years, I think it's fallen about 0.8% a year. So you could fast forward to 2035, maybe we're around 50% of global reserves. While the US dollar reserves are still growing in dollar amount, absolute terms. Still, the US conducts 88% of foreign currency trades, 54% of export invoicing, and 50% of cross border lending. No other country comes absolutely close to funding those trades, invoicing compared to the US dollar. So,
Look at
yes,
Carson, he's all pro America. Look at him.
it's losing its sexiness, but bottom line is there's no replacement. Where's the world
Yeah.
going to go for a reserve currency?
Yeah,
Um,
until at some point, if we really, really screw it up, which is possible, we're kind of kicking the can down the road on a lot of things, but it wouldn't be an investment thesis for us right now to start abandoning the U.S. or have a reason to think that if stuff gets really bad, that money's not going to flock into U.S. treasuries.
we're not helping ourselves by being $38 trillion in debt and continuing at this massive fiscal deficit. But I agree, there's no replacement. We can move on. The smaller side, just to back up that point, global market cap owned by the U.S. The share of global market cap, the U.S. makes up 66% of the world's global market cap. The top 7 companies, the Mag 7, no other company in the world from any other country comes close to those. Now we have Saudi Arabia, I think, comes in 8th place, and then there's some other companies, but the U.S. absolutely dominates overall
Yeah.
global marketplace. All right, let's shift gears here. So inflation and interest rates. Inflation, we all know, we had headline CPI grew to above 9% in 2022, and that's why we got the major shock to the system with the fastest rate hiking cycle in history. We're currently sitting around high twos, 3%. Not great. The Fed's target inflation rate is still sitting at 2%. So the Fed has two targets or two things they pay attention to. One, unemployment. Two, inflation. They are trying to keep the nation employed while lowering inflation. So fast forward, what happened in 2022? We had one of the fastest rate hiking cycles in history. We went from practically 0% interest rates to within the end of the year sitting at 5.5, 5.75% interest rates. That's why 2022 was a little shock to the system with the market correction, as well as fixed income having one of its worst years ever.
Yeah.
The reason this happened is, let me put this on top. So on top of one another. So in orange, you've got the Fed funds rate. In purple, you've got the inflation rate. I think from raising the federal funds rate to 5.5, 5.75%, it worked. Inflation came back down dramatically, but it didn't get to the Fed's 2% target. Then it wasn't at the 2% target. They started lowering interest rates because they're seeing unemployment tick up a little bit. So the Fed, what we have right now is this middle ground where I think the Fed is stuck. Do we continue to lower interest rates because unemployment's looking a little shaky, but inflation's still above 3%? Inflation expectations over the next year are risen to about 3.5%. The Fed's stuck. Do you lower interest rates while inflation's still high in order to keep unemployment? And this is where we can find ourselves in a stagflation environment.
Yeah.
It's pretty interesting, and I don't envy Powell's job to try to decide and gather enough data to make these types of decisions, because unemployment and inflation are two important factors. Bottom line, way to protect yourself against this: own assets, stocks, real estate. They're the only couple of items that are going to sit here and outperform an inflation rate. Moving forward, rate expectations, overall market expectations of interest rates are a slow path down to the sort of long-term terminal rate of 3 to 3.5%, 3 to 3.25%, really.
Not zero again. It'd be if we see zero again, like we did 5 years ago, then we're in trouble. But that was, don't get me started on that. That was way low and for way too long, and that's why housing prices got way out of whack, and affordability is at the worst it's ever been. So if we see that stabilize and mortgage rates, hopefully I'm not jumping ahead on any of the slides.
No, you're good. You're good.
If mortgage rates, you stay in the 6% range, long term, which is historically where they're at, and you should see housing prices, at least on the middle class end, stabilize. In 5 years from now, prices may be the same or not even go up, and that's probably what needs to happen because they got so out of whack. I mean, $1 million house going to $2 million in 4 years is unsustainable for any, for an average, increase in income of 3-4%. So
That's right.
they're trying to balance all that. There's a lot of things going on here, but it appears that the trend is going to be a very, very slow. Trump's unhappy that they're only dropping it, 25 bips versus 50, and because he wants it to get down lower and faster. And there's an argument for both sides on why both would be the right answer of going slow. But I think we'll see. Think we'll see that goal of 3% target rate continue.
Yeah, I think so too. Unless environment changes, but that's expectations on what we know right now.
Yeah.
Moving on, just want to touch on housing for a minute. This is a pretty interesting statistic. This is housing inventory for sale. This is comparing last month, so November of 2025 to November of 2019, pre-COVID housing inventory. Tennessee currently is sitting 37% higher than where it was pre-COVID. A lot of states are sitting higher than they were, except in the Northeast. They're still 30-40% pre-COVID level inventory. So we're seeing an increase in inventory, which is good from an affordability perspective, but from a selling perspective, you're not going to get a 2021 price when you're trying to sell a house when inventory is starting to be this high.
And that's why, like, our local, I can only speak to Nashville right now. Our local market's kind of stalled. We had a lot of real estate agent clients because people are still trying to sell their house at what they think it's worth from 2021, and they're just not moving. And so that's why the inventory. There's a lot of choices and a lot less buyers. At least here.
Let's look at, and the reason it slowed down so much from a buying perspective, we had the third highest reading of within a 12-month period how fast the 30-year mortgage rate increased. So over 2022, the 30-year mortgage rate increased from 3.2 to over 7%. That's almost a 4% spread in the average expected 30-year mortgage rate. That is a massive difference. And when you look at borrowing costs, what your mortgage payment looks to be, comparing a 3.2% rate to over 7%, that massive impact.
Not only that, if it was a $400,000 house and now it's selling for $800,000 and the rate's 7 versus 3, I mean, I'm making up numbers. I bet this is close. You're talking about a $2,000 a month mortgage or like a $5,500 or $6,000 mortgage for the same house just over a couple of years.
Exactly. That's why what's crushing affordability.
So people don't move. So then the inventories. So people stay in their house because they want to keep their mortgage rate the same, and then they just start renovating versus selling, and yada yada.
So what gives? I mean, that's the magic question. What gives? And on one hand, you could say, "Oh, I'm going to wait for rates to come back down to make things more affordable." Well, I know that's the wish. Here's current economic market expectations with the average 30-year mortgage rate. 3% mortgage rates are not coming anytime soon unless there's a catastrophic something that happens. So Average 30-year mortgage rate over the next 5 years is expected to increase. We're probably a 6% interest rate on a mortgage. If you can get anything under 6% based on current expectations, that's probably pretty solid. And the 30-year mortgage rate is not the Fed funds rate. So a lot of times people say, oh, the Fed's cutting interest rates, mortgage rates should start coming down. Not necessarily. You got to think the Fed funds rate is an overnight rate. It's basically a one-day loan as opposed to a mortgage is 30 years. So pretty different interest rates. So when it comes to, let's see, went back a couple. When it comes to market expectations on mortgages, just be aware of that. If you're buying, don't assume that just in a couple years when rates come down, you can refinance to afford it. Make sure you're comfortable with the current mortgage rate because you might not get a break in interest rates. Last couple of slides here. So these are on where the consumer is at and overall where the stock market's at. I love this slide from JP Morgan. It gives a great view of how the consumer is sitting and is the consumer healthy or not. On the left side, we have a consumer balance sheet. I mean, we've got over almost 10 times the amount of assets compared to liabilities on the average consumer balance sheet. Now, a lot of that is assets, or I'm sorry, a personal residence with a home. Other financial assets are things like IRAs, 401ks, stock market assets. The household debt service ratio in the top right corner, it's crept up since COVID, the era of free money, which was sub 10%, now to around 11%. We're not near the point of debt service ratios being pre-financial crisis around the 2007 level. We're still very, very healthy as far as the consumer goes. Debt delinquencies, the only thing that's come up is student loans because they were, to my knowledge, due dates came back and they started making people repay again. And then everything's just in a healthy spot, especially the consumer. There is a index that we look at called the Consumer Sentiment Index, and it asks consumers, the average consumer, two things. One, how confident are you on the economy? And two, how confident are you on your personal finances? It's near an all-time low over the past 55 years. It's hardly read a lower reading for how confident consumers are about the economy. Whether that's good or bad, people aren't feeling great about their personal finances right now. What that says about the stock market returns, historically, you can see these dot plots in blue. Historically, when we see such a low reading in consumer confidence, great performance in the stock market 1 year later. Doesn't mean that it's going to happen again, disclosure there, but history tells us that when consumers, they don't have a really good idea about, just because they don't feel great about their personal finances, doesn't mean the stock market's not going to have a good year. Pretty interesting slide. I didn't realize that. That was pretty interesting. Lastly, to touch on a couple of items with the stock market, we show this slide, these next couple of slides frequently. Year to date, so overall index up 15 or 16%. We experienced a 19% drawdown from the tariff tantrum back in April. Every single year, almost like clockwork, has a substantial drawdown. On average, there's a 14% drop, no matter if the market's up 34% or 16%. It rarely, over the past 40 years, I mean, what's this show? 1, 2, 3, 4, 5, 6, 7, 8, 9, maybe 10 years. So almost like clockwork. We say it all the time, David. 1 out of 4 years, the market's down. 3 out of 4, the market's up. Like this figure shows we had about 10 down years and 30 up years over the past 40, 45 years. And it's just a part of owning assets. If you want to participate in the up years, you got to realize that there's going to be some sort of substantial pullback throughout the year. I'm going to skip this slide, go to this last slide that I want to touch on is we're at basically all-time highs in the stock market right now. A lot of times when we come with cash, we either slowly dollar cost average it, or someone might come to us and say, hey, I've got a bunch of cash, but the stock market's at all-time highs. It feels too high. I don't necessarily want to invest. What this shows is that at all-time highs, you are more likely to have positive returns if you invest at all-time highs rather than on any other day. This is fascinating to me because you would think, oh, all-time highs.
It goes against all logic. And honestly, even what I've been used to thinking over my 23 years of doing this, it really defies kind of logic there, and definitely what people think, and better judgment usually tells us.
Mm-hmm. Now, the reason is because at all-time highs, the market usually, this graph shows us, is on a stretch. It continues to make all-time highs. I mean, we've been making all-time highs the past 2 years. Now, this chart right here, that 3-month bar, your average return is lower over the short term because the market could have a short term small pullback. But over the long term, investing at all-time highs, you're better off than investing at any other time period. Love that slide. That's all we got. I think the last thing we wanted to touch on was any questions. I don't have any questions. We must just covered everything way too well.
Yeah, if you have a question, go ahead and type it in. We'll give it another minute or so. If not, you can always email us, especially if you're a client. Well, really, if you're anybody, but you can email us. I know we have a lot of clients on here, and we can go through this. And you probably used to hearing us talk through this if you've been a client for a long time. You're probably just getting kind of an update. But yeah, we'll continue to. I mean, we're going to be making, rebalancing and changes to our clients' portfolios early in the year. Our investment committee is already meeting and deciding what those are. So we're on top of that as it relates to all this. But 2026 will be another interesting year. We'll have midterms to talk about. We know kind of historically what normally happens in midterms. Usually you have kind of a balance of power the other direction and that sort of thing. So who knows? Who knows what will happen there? But I'm not seeing any questions. So we'll work to put together a recording of this, get this out to you. And if you do have a question, reach out. And as always, thanks for being a part of what we're building here and for listening and for being part of our family.
That's right. We appreciate it. We'll get a recording out here probably early next week in case you want to follow up with it. But then if there's okay, I got one question here on the slide that was skipped. So I got to go back to it now real quick. It's just a diversification slide. So over a 1 year period, the green bar chart is the stock market. And it basically shows the volatility of returns over a 1 year period compared to bonds in blue and a diversified portfolio in gray. And basically how that narrows over time, the longer that you go. So over a 20-year period, you got a pretty tight window, diversified portfolio versus just a stock portfolio. So it screams, just because you're not up 50% in a year with the 60-40 portfolio doesn't mean it's not working over the long term. So hopefully that helped.
Yep. And then some other comments, just some other nice comments to us and the team. Thank you for those, but no other questions. All right. Thank you, everybody. We will talk soon.
Thank you.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.